What if I told you that the biggest threat to your retirement savings in 2026 is not a stock market crash, a recession, inflation, or even a scam artist? What if the danger is sitting inside the very account you trust the most? Millions of retirees believe their checking account or high yield savings account is the safest place for their money. They sleep peacefully, knowing their funds are protected, accessible, and earning interest. But what if that interest is quietly triggering a chain reaction that could increase your taxes, reduce the value of your Social Security benefits, and potentially raise your Medicare costs in future years? Most people never see it coming. The bank advertises a higher rate, the account balance grows, the monthly statements look better. Everything appears to be working exactly as planned. Then tax season arrives. Suddenly, income that seemed harmless starts affecting calculations most retirees never think about. Social Security taxation changes, income thresholds become relevant, future Medicare costs may begin moving in the wrong direction, and by the time the damage becomes visible, the interest has already been earned, the tax year has already passed, and the consequences are already locked in. The shocking part is that none of this requires a market crash or a bad investment decision. It happens through completely legal and completely ordinary financial activity. Today, we're going to examine how this process works, why so many retirees overlook it, and how a simple calculation could reveal whether a portion of your savings is quietly creating problems instead of helping your retirement plan. Before we continue, take a moment to like this video and subscribe. Financial rules change constantly, but understanding how those rules affect your retirement income can save thousands of dollars over time. The goal isn't to create fear. The goal is to help you understand how different parts of the system interact so you can make more informed decisions. Let's begin with a real-world example. Imagine a 72-year-old retiree who spent decades working, saving carefully, and avoiding unnecessary risks. She receives Social Security benefits each year, has a modest pension, maintains a traditional IRA, and keeps a substantial emergency fund in a high-yield savings account. Like many retirees, she believes she is doing exactly what financial experts recommend. Her savings account balance is approximately $215,000, and the account earns around 4.8% annually. At first glance, that seems like a smart move. Instead of allowing her money to sit idle, she earns more than $10,000 in annual interest. Most people would stop the analysis right there. More interest equals more income. Case closed. Unfortunately, retirement income planning is rarely that simple. The interest generated by that account doesn't exist in isolation. It becomes part of a larger financial picture. Once that interest appears on a tax return, it interacts with other income sources and can influence calculations that many retirees don't fully understand. That's where the hidden problem begins. Interest income is generally taxed as ordinary income. Unlike certain investments that may qualify for different tax treatment, bank interest is typically added directly to taxable income. For many retirees, that's not the only issue. The second issue involves something called provisional income. This calculation plays a major role in determining how much of your Social Security benefit may become subject to federal taxation. Many people assume Social Security is automatically tax-free. For some retirees, that is partially true. For others, it is not. The amount of Social Security that may be taxable depends on income levels and several factors considered by the IRS. When additional income enters the picture, including bank interest, it can push a retiree across important thresholds. Imagine someone sitting comfortably below a key income limit. Everything looks fine. Then a high-yield savings account generates several $1,000s of additional interest. That interest may seem harmless, but it can be enough to move the retiree into a different category where a larger percentage of Social Security benefits becomes taxable. Now, the retiree isn't just paying taxes on the interest. The interest has indirectly increased the taxation of benefits they were already receiving. That's where many people get surprised. They focus on the income being earned, but fail to calculate the secondary effects. The result is that the true after-tax value of the interest may be much lower than expected. Sometimes dramatically lower. This is why looking only at the advertised interest rate can be misleading. The advertised rate tells you how much the account earns. It does not tell you how that income affects the rest of your financial life. Banks are not required to perform retirement tax planning for customers. Their responsibility is to provide the account and pay the advertised rate. What happens on your tax return is largely your responsibility. That's why understanding the interaction between savings accounts, Social Security, and retirement income is so important. Now let's take the discussion one step further. Many retirees eventually begin taking required minimum distributions from traditional retirement accounts. When those distributions begin, taxable income often increases. The retiree who was once comfortably below important thresholds may suddenly find themselves much closer to them. Add pension income, add investment income, add savings account interest, add required minimum distributions, then combine all of those factors together. The financial picture can look very different than it did a few years earlier. This is one reason retirement planning isn't simply about maximizing income. It's about managing income efficiently. There is a major difference. Generating more income is beneficial only if the net result improves your overall financial position. Sometimes a dollar earned creates consequences elsewhere. That's why understanding the entire system matters. Another issue many retirees overlook is timing. A decision made today may affect taxes and costs years later. Income reported on a tax return doesn't always produce immediate consequences. Certain government programs evaluate income using information from prior years. That means today's financial decisions can influence future costs long after the original transaction has been forgotten. Many retirees never connect those dots. They see a higher account balance and assume everything is moving in the right direction. Meanwhile, invisible calculations are taking place behind the scenes. Income thresholds don't care whether income came from a paycheck, an investment, or a savings account. The numbers are simply added together, and when enough numbers accumulate, the results can change. This doesn't mean high-yield savings accounts are bad. Far from it. For many people, they serve an important purpose. They provide liquidity, they offer security, they allow emergency funds to earn a reasonable return. The goal is not to avoid them. The goal is to understand how much money should be kept in them relative to your overall financial situation. That's a completely different question. Instead of asking, "What interest rate am I earning?" a retiree should also ask, "What effect is this interest having on my entire retirement plan?" That single question can reveal opportunities and risks that otherwise remain hidden. Now let's discuss another topic that often creates confusion among retirees: large cash transactions. Many people have heard about reporting thresholds but don't fully understand how they work. As a result, they sometimes make decisions based on rumors rather than facts. Financial institutions are required to report certain large cash transactions. These reports are part of regulatory compliance systems designed to monitor unusual financial activity. For law-abiding retirees, the existence of these reports is generally not a problem. The problem occurs when people misunderstand the rules and attempt to structure transactions around thresholds. Someone hears a story from a friend. Someone else repeats advice from a neighbor. Eventually, myths spread faster than facts. The safest approach is always transparency and compliance with applicable laws. Trying to manipulate transaction sizes to avoid reporting requirements can create unnecessary complications. Most retirees have no intention of doing anything wrong, yet confusion alone can sometimes create problems. That's why understanding the rules is far better than relying on assumptions. The broader lesson is simple. Retirement planning today is more complex than it was decades ago. Many financial thresholds were established years ago and have not always kept pace with economic changes. As a result, retirees must pay closer attention to how income sources interact. A decision that appears beneficial in one area can produce unexpected consequences in another. That's exactly why comprehensive planning matters. Not because retirement is impossible, not because the system is broken, but because financial decisions are interconnected. Every account influences another account. Every income source affects another calculation. Every choice creates a ripple effect. The retirees who thrive financially are often the ones who understand those connections before they become expensive. And that brings us to the most important question. How do you determine whether your savings balance is helping or hurting your retirement strategy? The answer starts with knowing your numbers. You need to understand your annual income sources. You need to estimate how much interest your accounts generate. You need to evaluate where that income places you relative to important thresholds. And most importantly, you need to examine the entire picture rather than focusing on a single account. Because retirement success is not determined by one interest rate. It is determined by how all the pieces work together. Once you understand that principle, the next step becomes much easier. Start by listing every source of income you expect to receive during the year. Include Social Security benefits, include pension payments, include dividends, include rental income, include part-time work, include retirement account withdrawals, and include the interest generated by your savings accounts. Many retirees are surprised when they perform this exercise for the first time because they discover their income picture is much more complex than they realized. What seemed like a collection of unrelated payments is actually a connected financial system. Every dollar affects another dollar. Every source influences another calculation. When you begin looking at retirement this way, you stop viewing accounts individually and start viewing them as components of a larger strategy. That shift in perspective can be incredibly valuable. Consider two retirees with identical net worth. One keeps the majority of liquid assets in interest-bearing accounts without considering tax consequences. The other evaluates how each income source affects taxes, benefits, and future planning opportunities. Over time, the second retiree may retain significantly more wealth even if both individuals earn similar returns. Why? Because keeping money is often just as important as making money. This is one of the biggest misconceptions in retirement planning. People spend enormous amounts of time chasing yield, but very little time analyzing efficiency. A higher return does not automatically produce a better outcome. The after-tax result is what truly matters. That's the number that determines purchasing power. That's the number that affects lifestyle. That's the number that influences long-term financial security. Unfortunately, many advertisements focus only on gross returns. They highlight what you earn, they rarely discuss what you keep. And there is a huge difference between those two figures. This is why retirees should never make financial decisions based solely on promotional materials. Advertisements are designed to attract attention. They are not designed to provide comprehensive retirement planning. No marketing flyer knows your income level, no advertisement understands your tax situation, no bank employee can automatically calculate the interaction between every account you own. Only a complete review of your financial picture can accomplish that. That's why informed decision-making matters. The more you understand, the more control you have. The less you understand, the more likely you are to discover surprises later. And retirement is the stage of life where surprises become especially expensive. Now let's talk about what many retirees should consider doing if they discover that a large portion of their savings may be creating unintended consequences. The first step is not panic. The first step is analysis. Never make major financial changes based solely on a video, article, or conversation. Gather the facts, review your income, understand your tax situation, consult a qualified professional when necessary. Only then should you evaluate potential adjustments. Some retirees may determine that their current setup is perfectly appropriate. Others may discover opportunities to improve efficiency. The answer depends entirely on individual circumstances. There is no universal solution. Anyone promising a one-size-fits-all retirement strategy should immediately raise concerns. Retirement planning is personal. Your income sources are unique. Your goals are unique. Your risk tolerance is unique. Your tax situation is unique. Therefore, your strategy should be unique as well. That said, there are several categories of options often explored by retirees seeking greater tax efficiency. Some focus on long-term tax diversification. Others focus on reducing future required distributions. Others emphasize capital preservation while managing taxable income. The appropriate choice depends on the broader financial picture. What matters most is understanding why changes are being made. Every adjustment should serve a specific purpose. Moving money without understanding the objective can create new problems while solving old ones. The best financial decisions are intentional. They are based on numbers rather than emotions. They are based on planning rather than marketing. And they are based on long-term outcomes rather than short-term excitement. This brings us to a question that deserves serious attention. Why do so many retirees overlook these issues in the first place? The answer is surprisingly simple. Most people are busy. They spent decades working. They raised families. They paid mortgages. They saved consistently. By the time retirement arrives, many assume the difficult part is over. In reality, retirement introduces an entirely different set of financial challenges. Accumulating wealth and managing wealth are not the same thing. Building assets requires one set of skills. Protecting assets requires another. Generating income requires one strategy. Managing taxable income requires another. Many retirees enter this stage prepared for the first challenge but not the second. That is completely understandable. The financial world has become increasingly complicated. Rules change, thresholds change, tax laws evolve, benefit calculations shift. Keeping up with everything can feel overwhelming. But here's the encouraging news. You don't need to become a tax attorney. You don't need to become an accountant. You don't need to spend every weekend reading government publications. You simply need to understand the major concepts that affect your retirement. A small amount of knowledge can prevent very costly mistakes. And often, the biggest benefits come from asking the right questions. Questions such as, how much interest am I generating annually? How does that interest affect my taxable income? How does my income affect Social Security taxation? How close am I to important thresholds? What impact might future retirement account withdrawals have? What happens if I continue following the same strategy for the next 5 years? Those questions can reveal information that many retirees never examine. And once you have those answers, decision-making becomes much easier. Instead of guessing, you know. Instead of reacting, you plan. Instead of being surprised, you prepare. That preparation can make an enormous difference. Think about the retirees who discover a problem only after receiving a tax bill. Their options are limited. The year has already ended. The income has already been earned. The calculations have already been completed. In many cases, there is little they can do retroactively. Now think about the retiree who identifies the issue months before year end. That person still has flexibility. That person still has choices. That person still has time. Time is one of the most valuable assets in financial planning. The earlier you identify potential issues, the more options you have available. That's why waiting until tax season is often a mistake. Tax season explains what happened. Planning season influences what happens next. And retirees who focus on planning rather than reacting generally achieve better outcomes. There is another important lesson here. Financial literacy is not about predicting the future. No one can guarantee market returns. No one can guarantee future legislation. No one can eliminate uncertainty. What financial literacy does provide is awareness. Awareness helps you recognize opportunities. Awareness helps you identify risks. Awareness helps you ask better questions. And better questions usually lead to better decisions. The reality is that most retirement mistakes are not caused by bad intentions. They are caused by incomplete information. People simply don't know what they don't know. They assume everything is fine because nothing appears wrong on the surface. Meanwhile, small inefficiencies accumulate year after year. Eventually, those inefficiencies become significant. That's why education matters. Not because every retiree must become an expert, but because every retiree deserves to understand the major forces affecting their financial future. The goal isn't perfection. The goal is improvement. Even small improvements can create meaningful results over time. Reducing unnecessary taxes, avoiding preventable costs, managing income strategically, protecting purchasing power. These actions may seem minor individually, but together they can have a powerful effect on long-term retirement security. As we wrap up, remember the central message. The safest looking account isn't always the simplest account. A savings account may provide security, liquidity, and peace of mind, all of which are important. But every financial tool comes with consequences. The key is understanding those consequences before they become expensive. Take time to review your income sources. Examine your annual interest earnings. Understand how those earnings fit into your broader retirement strategy. Run the numbers. Ask questions. Seek professional guidance when appropriate. Most importantly, avoid making assumptions. The financial world rewards people who understand how systems interact. Retirement planning is no longer just about saving money. It's about managing income efficiently. It's about understanding taxation. It's about protecting benefits. It's about coordinating multiple moving parts. And it's about ensuring that every dollar works as hard as possible for your future. The retirees who succeed are rarely the ones who chase the highest advertised rate. They are the ones who understand the complete picture. They know their numbers. They understand the rules. They make decisions based on facts rather than marketing, and they recognize that true financial security comes from knowledge as much as it comes from money. So before this week ends, take a closer look at your accounts, review your income, calculate your interest earnings, understand where you stand, because the earlier you identify potential issues, the easier they are to solve. Your retirement savings worked hard for decades to reach this point. Now it's your turn to make sure those savings continue working for you rather than quietly creating challenges you never intended. Stay informed, stay proactive, keep asking questions, and keep making decisions based on the full financial picture rather than a single number on a bank statement. The difference between those two approaches could have a major impact on your retirement for years to come. USA Security Check.